Welcome to CoreLogic's update on housing market conditions for August 2019, brought to you by onthehouse.com.au. Dwelling values may have found a floor in July, with our national index holding firm over the month, following a consistent trend towards smaller month-on-month declines through the first half of the year. The stabilisation in housing values is becoming more broadly based, with 5 of the 8 capital cities recording a subtle rise in values over the month, while the regional areas of South Australia, Tasmania and the Northern Territory also recorded a lift in housing values in July. A number of factors are supporting a turnaround in housing market conditions. However, lower mortgage rates, improved access to credit and a boost in housing market confidence post the federal election are likely to be the primary drivers. Other factors include improvements in housing affordability, a reduction in advertised supply levels, and recent tax cuts for low-income earners. Mortgage rates are currently at levels not seen since the 1950s, which is motivating buyers back into the marketplace after annual housing sales fell by almost 30% from their 2016 peak. With housing values down a bit more than 8% nationally and substantially larger falls across the most expensive markets, housing has become much more affordable and access to credit has become a little bit easier, with lenders using lower interest rates to calculate whether a borrower is able to service their mortgage. The improved housing market conditions have lifted the annual rate of decline to negative 6.4% nationally, with annual falls easing from a recent low of negative 8.4% to negative 7.3% across the combined capitals, while values are 3% lower over the year across the combined regional areas of Australia. From a geographical perspective, the primary drivers of the turnaround in housing market performance are Australia's 2 largest capital cities, Sydney and Melbourne, where values have ticked higher over the past 2 months, taking values 0.3% off their floor in Sydney and 0.4% higher in Melbourne. The 0.2% lift in Brisbane values was the first month-on-month rise since November last year. Values were also higher in Darwin and Canberra over the month. While values look to be stabilising or edging higher in some cities, transactional activity is also reflecting a levelling out in buyer demand. The 6-month trend in settled sales has turned a corner, bottoming out at a similar level to the previous 2 downturns. While the macro view of the housing market is looking healthier, conditions vary substantially across the cities. In Sydney, housing values ticked slightly higher for the 2nd consecutive month, providing further confirmation that the market has commenced what's likely to be a gradual recovery after values fell by almost 15% from the July 2017 peak. The unit sector is showing a slightly stronger performance relative to houses, with values declining less during the down phase and slightly leading the charge as the market stabilises. The better performance of units amidst a surge of new apartment supply may seem surprising. However, most of the new unit stock was sold several years ago when conditions were quite different. There is a strong chance we could see some dampening of price growth across the high-rise unit sector as resales of new stock start to pick up. Melbourne dwelling values have shown a slight rise over the past 2 months, up 0.2% in June and 0.3% higher in July. The subtle rise in values comes after an 11.1% decline between the market peak and what seems to be a trough in May earlier this year. Unit values have shown some resilience during the downturn, with values falling only 4.6%, while house values are 14.1% below their peak. Similarly, the rise in dwelling values across Melbourne has been higher for unit values, which are up 1.1% over the past 3 months, and for houses, which remain 0.3% lower over the same period. Similar to Sydney, the strength of the unit sector may come as a surprise considering the elevated supply levels. However, the large majority of stock was sold when prices were generally higher. We could see some downward pressure of high-rise unit values as newly built stock enters the resale market. The Brisbane housing market recorded a 0.2% rise in values over the month of July, which was the first month-on-month increase in values since November last year. Brisbane's downturn has been quite shallow, with local values only 2.9% below their peak. The market peak was much later than Sydney and Melbourne's and followed a relatively mild growth cycle, where growth in housing values has averaged only 1.4% per annum over the past 5 years. There's little difference between the performance of houses and units across Brisbane, with values down 0.8% over the past 3 months across both sectors of the market. Although values are still trending lower, the local unit market seems to have emerged from the supply hangover, which has dragged values lower over the past few years. Adelaide values dipped 0.3% in July, taking the 3-month trend to negative 0.6% and the annual decline to negative 0.8%. The monthly fall is likely to be temporary, with Adelaide housing conditions generally reflecting a stable trajectory. In fact, the trend in settled sales activity is improving, with home sales creeping back towards the decade average over the past few months. Properties are taking 50 days to sell on average across Adelaide, up from 44 days a year earlier, suggesting the buyers aren't really facing a great deal of urgency at the moment. Values across Perth took another step backwards, declining 0.5% over the month, taking the cumulative decline to a little over 20% since the market peaked in mid-2014. Perth house values are the lowest of any capital city, with a median of $459,000, highlighting one of the few positives of such a sustained housing market downturn, which is a significant improvement in housing affordability. It's hard to know when this market is going to turn around. However, there are some positive signs from improved migration rates, a pickup in jobs growth, and unemployment, which is trending lower. Hobart housing values have bounced a little higher over the past 2 months, following 2 months where housing values fell. Reading through the month-to-month volatility, it's clear that momentum is continuing to slow down across the Hobart market. Values were virtually flat over the past 3 months, while a year ago, the quarterly rate of growth was tracking at 1.1%. The most affordable quartile of Hobart's housing market is showing the strongest conditions, with values 1.8% higher over the past 3 months compared to a 1.1% decline across the top quartile. Darwin housing values posted a rare increase in July, up 0.4%. While the positive movement is encouraging, the Darwin Housing Index does show higher volatility due to the small number of dwellings, which is compounded by a low rate of turnover. The overall trend in the data remains weak, especially in the unit market, where values are 41% below their peak and house values are 25% below their peak. Economic and demographic indicators aren't really showing any sign of improving, suggesting the monthly rise in July is likely to be short-lived. Canberra dwelling values posted their 3rd consecutive month-on-month decline in July, taking values 1.5% lower over the rolling quarter, which was the softest result since 2012. Unit values are falling at an annual rate of 2%, while house values have been more resilient, posting an annual rise of 1.9%. The weaker unit market may be an indicator that higher supply levels are weighing on the market. Overall, the July Home Value Index results provide further confirmation that the housing market has reacted positively to the recent stimulus of lower mortgage rates and improved credit availability. However, the response to date has been relatively mild. While the CoreLogic indices are a timely reference for housing values, other housing and credit indicators are also showing a positive trend. Auction clearance rates have been holding above 70% through most of July across Sydney and Melbourne, indicating a better fit between buyer and selling pricing expectations. At the same time, advertised stock levels have been reducing. Across the combined capital cities, the number of freshly advertised properties is down 25% relative to the same time last year, and total advertised stock levels are now tracking 5% lower relative to a year ago. The reduction in available stock creates less competition amongst sellers and increased competition amongst buyers, adding support to higher prices. Importantly, the trends in housing credit have also been pointing towards stability. Although housing finance data from the Australian Bureau of Statistics is only current to May, the trend leading up to June was clearly pointing towards an easing in the credit downturn. Recent CoreLogic valuations platform data shows a modest rise in the daily number of mortgage-related valuation events, signalling a lift in housing finance commitments over the most recent 2 months. Although the trend towards a recovery in housing values is relatively fresh and centred within the 2 largest cities, we aren't seeing any signs that there will be a V-shaped recovery. Despite an improvement in credit availability, housing credit policies remain much tougher than they were prior to the Royal Commission, as lenders continue to move away from the household expenditure measure and examine borrower spending behaviours and expenses much more closely. Also, lenders now have the benefit of comprehensive credit reporting, whereby borrower debt profiles are much more transparent, providing lenders with the ability to assess creditworthiness in much more detail. The ongoing tightness in housing credit is expected to keep a rapid rebound in housing values at bay, despite the lowest mortgage rates since the 1950s. No doubt, policymakers will be keeping a close eye for signs of investor exuberance or a more rapid acceleration in the recovery trend. If values were to start appreciating more rapidly, there could be a renewed round of policy responses aimed at keeping a lid on housing prices, whilst at the same time allowing low interest rates to stimulate the economy more broadly. With so much change taking place across the housing market, it seems there's even more attention than normal on the trends. Make sure you're staying up to date with all the facts and figures at www.corelogic.com.au.